Okay, I think we should get started. Ladies and gentlemen. Okay, so I'm happy to convene the last panel on, which is a continuation of the discussion we were just having on where is mortgage market reform headed. As Karen said, 9 years and 22 days or whatever it is in conservatorship is a long time. And, but there are things that are changing even without a comprehensive reform proposal. So I think you'll find this panel interesting. It'll provide an outlook on views on where reform might be going, but also on what's already happening in terms of changes in the way the GSEs are doing business. So our first speaker is going to be Jim Parrott.
Do you mind if I sit down? It seems more laid back if I just
Panel-esque.
talk from the...
You can
Do you
talk,
care? You seem
talk
that
from
seems to put you
wherever
out.
you like
sure?
to. Yes. No.
Okay. All right. Well, I'm going to stay seated. So thank you. First of all, thank you for having me and the rest of us here to talk about this. I thought that I would begin with a little bit of sort of level setting and reminding folks of the structure of the system that we're all talking about reforming. Here I've got a slide that shows what the system looked like just at a very high level in the crisis heading into conservatorship. As you'll see, the box that jumps out at you obviously is Fannie and Freddie, and it drives home the centrality of their role in the system. Heading into conservatorship, they managed all the securitization within this channel. They assumed almost all the credit risk in the channel, with the exception being what the MIs took. So if you think about the basic functions that the system provided, heading into conservatorship, if they were lending and servicing, securitization, the assumption of credit risk, and the assumption of interest rate risk, Fannie and Freddie handled the entirety of 2 of those 4 or 5 functions, depending on how you cut it. Obviously, that means that we couldn't possibly have let them fall, because if they had fallen, they would have taken down this entire channel and made it hard, if not impossible, to get those loans that depended on this channel to be made. Our utter dependency on them as institutions was widely known by policymakers, and more importantly known well by Fannie and Freddie themselves. That created a deeply problematic set of incentives for Fannie and Freddie because they had plenty of incentive to take excessive risk, because they would benefit from the upside if the risk paid off, and we would all get stuck with the downside if, as it turns out, the risk didn't pay off. So not only do we depend entirely on 2 institutions, a duopoly at the center of the system, but we incentivize them to take on excessive risk right there at the center of the system. So I think coming out of the crisis, most folks agreed that whatever else you think of with housing finance reform, one of the primary objectives has to be to reduce our dependence on this too big to fail duopoly right at the center of the system. And so really, since they've been in conservatorship, we've seen that begin to happen. So under the guidance of the conservator under FHFA, first DeMarco and now Mel Watt, you've seen Fannie and Freddie building out a common securitization platform, that's what CSP stands for, which will ultimately handle the securitization that takes place within this channel. And we've seen Fannie and Freddie required to, or at least nudged to sell off a large chunk of its credit risk into the credit markets, which is to say we're reducing our reliance on them for those 2 core functions, which they dominated through the crisis, leading to the problematic incentives. So where do you go from here? I think there's a relatively broad consensus, certainly not universal, that reform should have some mix of these principles. Some folks add a few principles here. Some may strike one from the list. But whether or not we see reform that looks at all like that really comes down to probably what happens in the Senate. So I'm now going to pivot from history and now think a little bit or talk a little bit about prospectively where we're headed. In order to get reform going, you're going to need to see a bipartisan bill passed out of the Senate Banking Committee. It's going to need to be passed out of the Senate Banking Committee with enough bipartisan support that it gets interest from a bipartisan group on the Senate floor itself. As Karen mentioned, the last legislative effort failed, in large part because progressives refused to support it back in the day. Harry Reid, who was the majority leader, didn't bother bringing it up on the floor because without progressive support, he figured probably rightfully that they wouldn't get enough Democratic support on the floor. At the very least, it would lead to a pretty divisive fight. And so right now you've got a similar sort of behind-the-scenes negotiation going on in the Senate Banking Committee that has really two pieces to it. One, you've got Chairman Crapo, the chairman of the Senate Banking Committee, who's been involved in this discussion now for a long time. He was the ranking minority leader in the last legislative effort, is trying to get Sherrod Brown, who is the ranking minority member now, to agree to a sort of blueprint for reform under the view that in order to get a bipartisan bill passed out of the Senate Banking Committee, it would be very helpful to have Brown's name on it. So Crapo has been working, or his staff, I should say, has been working with Brown's staff to see where the area of compromise is. The second process that's going on at the same time is there's a weekly working group among as many as a half dozen, 6 or 7 other Senate banking members, more sort of centrist members, led by Corker and Warner. And I'll talk a minute about the relevance of Corker's announcement in a second, but led by Corker and Warner to, in essence, map out what that sort of centrist group of members thinks compromise probably needs to look at to keep a broad coalition on board. This is roughly how the Johnson Crapo deliberations last time played out. You had this kind of centrist group trying to figure out where the center is. The idea being that they want to be close to being able to draft legislation for when the leaders give them a green light to go ahead and come out with a proposal. And they have made a lot of progress, the working group. That is, I feel pretty comfortable that if Crapo gave them a green light tomorrow, they could draft legislation in relatively short order. The challenge, though, is there really are two challenges. One is what is it going to take to get progressives on board? This time around, like last time, they really have to find a couple progressives to add to the bill. Otherwise, it's going to scare off all the Democrats on the Senate floor once the bill goes to the floor. And the progressives have been pretty cagey about what it is they want in a bill, but there's a back and forth about what it's going to take to get, whether it's Chris Van Hollen, who's a new member of the Banking Committee, who's considered part of that progressive caucus, Elizabeth Warren, who is much more open in negotiating on this than she is on some other issues. Brown seems to be pretty reticent about engaging on this. Hard to say exactly why, because he's been pretty cagey. There's some assumption that what's going on is that he thinks that the status quo is preferable to anything he'd be able to legislate with the current sort of Republican hegemony in place. Anyway, they've remained a bit of a mystery, the progressives, on this until the moderates can crack that mystery. Hard to see how anything gets out of the Senate Banking Committee in a way that has any prospects.
Well, next we have Mike Fratantoni.
Thank you. So, Debbie, thanks for inviting me here. So Jim worked in the White House, gave you a very good political scan, what the perspectives are in terms of where reform is headed. I'm chief economist at the Mortgage Bankers Association, so Debbie asked me to give, to one of Karen's comments, one of the major stakeholders in this discussion, where does industry think this is headed? I've had the opportunity in the post-conservatorship environment to be part of 3 separate task forces that MBA has put together for folks that have not worked in a trade association before, let me give you a little insight into how the sausage gets made. It's not that different from democracy writ large, right? So we have 2,500 companies that are members. And that's everybody from small, family-owned mortgage bankers to Wells Fargo, Bank of America, people that are active in the single-family market, people that are active in the multifamily market, people that are entirely dependent for their business lives in the GSEs, people that wish the GSEs would go away, right? And through a cross-section of that membership, we put together task forces and try to come up with a uniform view as to where we think things should head. And again, I've been done this 3 times since 2009, and what's sort of interesting is when you get a group of lenders like that together, they come to some fairly consistent answers in terms of what you'd want from the future, and it basically works out to there are aspects of the prior system which worked really pretty well, and you want to keep those. There are aspects of the prior system which were really severe problems, led to a global financial crisis, but also weren't working even when times were good, and we'd like to fix that. And then, again, this is not a blank slate. We have to get from here to there, so any changes that we want to make, we want to conserve and preserve what we can and sort of build off of what's already there. And also minimize the chance of financial disruption through a transition. So most recent version of our task force, we put out a paper in April. I really enjoyed today's papers, but obviously our paper is meant for a different audience. It's meant for a congressional and policymaker audience, so more conceptual and operational, but also kind of aspirational, right? So I thought Ed's paper was great in sort of thinking about some of the trade-offs, and we tried to be really explicit that regardless of which changes you make to the system, you're trying to balance 3 goals. One, you're trying to protect the taxpayer. So we came out with a proposal which would ask for a explicit guarantee behind mortgage-backed securities, full faith and credit, that will be paid for. And if you're going to do that, you got to make sure it's essentially never called upon. So it's there to promote liquidity in the market, but it's not something that's going to be tapped. That was the first. The second is you want to, any changes you make, you don't want to unnecessarily add to borrower cost or unnecessarily restrict access to credit, again, because that's what we're doing this all for. That's the goal of public policy. Third, it has to be viable, right? So any businesses that you put on the center of these diagrams have to be able to attract capital and be successful over the course of a cycle. So you can see that if you push too far in any one of those 3 directions, it's not going to work, right? So I think, again, Ed's spider diagrams are perfect in the sense that you have to keep all these goals in mind at the same time. So what did work in the pre-conservatorship system? Mentioned earlier about just the liquidity in the MBS market, so second most liquid market in the world, hundreds of billions transacting every day. Those are real benefits that flow through in terms of lower cost and greater access for borrowers. The GSEs brought a lot of standardization to the market over time, and that's been beneficial. Hasn't been mentioned yet today, but very important to our membership, the multifamily system has worked extremely well. Much more risk sharing than was present in the single family market. And really didn't suffer the same kind of losses. So there's lots to build there. There's a model to build from in terms of that successful multifamily market. And I think the GSEs historically performed an important gatekeeping function, right? For a long time, a prime mortgage was something that the GSEs would buy, and they held to a fairly strict set of standards. They obviously strayed from that, which was a problem. So what didn't work? I think sort of to the heart of this gathering here, having an implicit guarantee on 2 companies led to all kinds of problems, whether it's moral hazard or excessive growth, and heads I win, tails the taxpayer loses kind of behavior. It's beyond that, though, and I thought it was really interesting that you had a panel on sort of debt in China here, because there's obviously a connection to that, right? So for folks that are familiar with it, in the heart of the crisis, the People's Bank of China was calling Treasury and visiting the GSE's regulator and saying, "Are you keeping my money safe?" Right? To Jim's picture about interest rate investors and credit investors, the credit investors tend to be domestic. The rate investors are global. And we had gotten ourselves in a situation where we had to protect the GSEs, absolutely had to, because Treasury felt that they were at risk. So that's not a situation you want to be in anymore. So be explicit about what you're protecting, be explicit about what you're not protecting. Coupled with that was Fannie and Freddie had enormous investment portfolios, almost $1 trillion each. Coupled with that, huge derivatives books. They were closely tied and linked to basically every large financial institution in the country and many around the world, and hence the systemic risk that flowed from that. So not something you'd want to retain. And going into the crisis were really a source of liquidity risk. It made it an imminent failure, as opposed if they had just been focused on the guarantee business, it would have been a slow-burning fire as opposed to a crisis. Another problem, and again, this is really one that the industry focuses in on, was the lack of competition. So you had these two companies with congressionally granted charters. There was no ability for a new entrant to come in on the same terms. And I thought Ben Key's paper was good in terms of really focusing on the amount of leverage that the GSEs had over multiple players in the system, whether it be lenders or MIs, vendors. Was really incredible, and they certainly utilized that leverage. Certainly been highlighted, they had very weak capital standards, so for the MBS outstanding, they had to hold 45 basis points of capital. If they had held 10 times as much, they probably would have gotten through the crisis. Instead, you needed $187 billion of taxpayer capital. A relatively weak supervisor in OFEO, who was strengthened as we were heading into the crisis with FHFA. FHFA has more bank-like regulatory powers, but maybe a little bit more work to do there. Another sort of industry perspective that, again, I think Ben picked up on a little bit is because of the GSE's market power and the leverage they absolutely had the ability to pick winners and losers in the primary market. You saw that with lenders, so if it was I worked at Washington Mutual or Countrywide or Wells Fargo, they would negotiate a guarantee fee based on the volume they were bringing of 7, 8, 9 basis points, where your typical lender was paying between 25 and 30 basis points. That may not sound very large, but to the picture that Paul Willen was showing, that's the reason you had those intermediaries in the middle, right? Because if these smaller lenders could go directly to Fannie or Freddie, they would. Because if you're going through that intermediary, you're basically saying, here's my customer. Sell him anything you want, and by the way, next time he goes for a mortgage, he's going to go to you and not me. It's not a happy situation for a smaller lender to face. But given that price differential, they had to, or else they do no business. So this extraordinarily unlevel playing field between the largest volume producers and the smaller really led to distortions in the market, something that you'd want to correct going forward. So in conservatorship in September of 2008, you had first Director DeMarco and then Director Watt really pursue a number of steps that have been very positive and we think headed in the right direction. So first is addressing this unlevel playing field issue. So I believe it was in 2010 or 2011, made a decision that no more discounts on volume. Every lender that comes in gets the same price. There was a comment earlier that you've seen a reduction in concentration in the industry, direct result of that, right? So everybody can enter the secondary market, hitting the same credit standards, gets the same price. You've certainly had tighter supervision. You've had FHFA weighing in on every decision of note. Another certainly a problem with the old system was that you had this immense concentration of credit risk sitting on the Fannie and Freddie balance sheets. There's been a big push to disperse that through various credit risk transfer mechanisms. And then finally, starting with Director DeMarco, again, continuing with Director Watt, a couple of decisions which should help the potential for new entrants going forward. So getting rid of some of the fixed costs in addition to the congressional charters by creating a common securitization platform, so sort of the back office securitization functions, and moving Fannie and Freddie towards a single security. Again, the issues with volume is that Fannie was always the larger issuer, and just as a result of that, got a liquidity benefit in the market and had a much better execution. Freddie always had to pay up to try to counter that. There was no way you could get an additional entrant if they had to compete against that sort of installed base that Fannie had. If you move to a single security, you've really dramatically reduced the cost to entry or the barriers to entry. So the chart I have up here is just thinking about each of those different components, sort of what would we keep from the old market, what's been some positive steps that have been made through conservatorship that we want to lock in, what are some additional changes that we need to be made. We think they need to be made by Congress, so you can't provide an explicit guarantee behind a mortgage-backed security unless Congress decides to do that. You can't move from a system of congressional charters to regulator-granted charters unless Congress decides to do that. But many of the other steps, it really is just a question of locking in things that have already been done. So we've gotten a number of questions talking to the same folks that Jim is of, okay, so would anybody show up if we actually open this up to additional competition? And again, we put out our paper in April, and guess was sort of happily surprised that my phone keeps ringing with companies that say, okay, well, what do you mean by this, and what do you mean by that, and how do you think this aspect would work out? Because we're sort of kicking it around, and some of it are the types of companies that you would expect that are already sort of incumbents in the market in one way or another. Some of it are not. They're potentially disruptors who would look at this a different way, particularly ones that are more operationally focused and where Fannie and Freddie have really been resistant to credit risk transfer, particularly Fannie. Some of these other potential new entrants, this is what they do for a life. They're sort of operational market makers, don't have a desire to take on a lot of credit risk. So that's my handoff to Ed in terms of thinking about credit risk transfer, but we can save the rest for conversation.
Right. So just to say that Dick McWilliams, unfortunately wasn't feeling well, but Ed is going to step in and.
Thank you. Again, thanks for inviting Dick. I wasn't supposed to be presenting at all, so Jane had that unexpected birthday. Dick had an unexpected illness, food poisoning. He's doing fine. But I have been working with Dick at a company, and yeah, I'll speak into the microphone. I've been working, Dick McWilliams is a fascinating person. Is not a mortgage guy per se, but he has been involved in different indices and data provisions to the capital markets in different forms. And he, several years ago, decided that it would be great if there were better benchmarks or indices around mortgage credit risk. And the advent of the credit risk transfers, Freddie Mac, Stacker securities, and Fannie's Cask, Connecticut Avenue securities, provides an important market that's likely to be part of housing finance reform. Putting back on my economist hat, there's nothing wrong with common equity. And having been head of shareholder relations at Freddie Mac going into conservatorship, people like Bill Miller at Legg Mason somehow really thought he had private capital behind the GSEs. The problem was, of course, there wasn't enough of it, not that there wasn't any private equity. And in many ways, the body politic that Jim talked about, it starts to throw around numbers like you need 10% common equity in order to capitalize this market. The fact is, if you really sharpen your pencil and you do decent underwriting, so you actually insist on the documentation, while the answer lies between 45 basis points and 10%, I would actually argue that for a well-written book of business, it's actually much closer to the 45 basis points. If the GSEs hadn't had the investment portfolios, hadn't had the subprime securities, and were just doing FAS 5 accounting on a well-underwritten business, it can be a safe business. But the body politic somehow has this 10% number, and you can't capitalize $5 trillion very easily at reasonable mortgage rates, what I'll call reasonable mortgage rates. You can't capitalize $5 trillion of mortgages at 10% common equity today and still have the low mortgage rates that we want out there. So credit risk transfers are an ingenious way of tapping into private capital without having to go through, just exorbitant levels of common equity. So it is likely to be, whether it's in the current conservatorship, which my private opinion is we'll see for 20 years, we'll still have some form of conservatorship because I think, as Jim points out, it's working. That's not what my desired outcome is. It's just a question of forecasting. Whether we have that conservatorship for 20 years and CRT continues to be the way, when you can't have common equity, of transferring the risk to the capital markets, or if ideally you do have good housing finance reform, it's likely to rely on these credit risk transfers going forward. So it is important to establish better transparency and liquidity into this market. And I can talk more about it, but providing indices, whether it's value indices or total rate of return indices, are an important way of being able to benchmark. If you're going to do an ETF, it's important to have these and bring more investors in. And I'm always reluctant to use the word, but if you also are going to have any form of options or futures or swaps on mortgage credit risk, if people want to be able to go long and short, it's important to have a well-established index. So I would expect to see this is the way that the market is distributing credit risk into the private sector, very similar to how CMOs and REMICs distributed interest rate risk into the private sector. You want to be able to do it in a way with sort of good transparency in liquid markets. And that's one of the things that sort of Dick and I are working on. So we think it's going to be an important part going forward. There are downsides on doing it this way, and I think the GSEs and FHFA are working to mitigate that. And that often comes around issues of loan modifications and innovation. It's easier for common shareholders to say, I'm willing to make this bet that a loan modification is going to save me money, and I'm willing to put my capital behind it. It's harder to sell that into a structured credit risk market. So with anything, even with this, there are trade-offs that need to be managed. But do see that there's no reason not to use capital markets. The GSEs between them, I think, have issued approximately $50 billion worth of credit risk transfer securities into the market. If they had, as a steady state on their $5 trillion of outstanding mortgage credit risk that they take, that market will sort of naturally probably grow to closer to the $200 billion level. So it's going to be sort of a large market, and it's important that it sort of gets supported the way other capital markets do, with clarity, transparency, and liquidity on that. So we see it as something that's here to stay, and we sort of look forward to the development of the market, either post-legislation or in conservatorship.
I'm going to open it up to questions, but actually, because I'm not sure that everyone is that familiar with CRT, and I think part of the plan was to explain what it was, I'm going to do a 3-minute extemp on credit risk transfers. So what's changed with the GSEs under conservatorship is, as we've been talking about, there's a desire to get private risk-bearing back into the mortgage credit risk market. So what's happened is that both Fannie Mae and Freddie Mac have started issuing what are essentially catastrophe bonds. These are bonds that pay some fixed or floating level of interest minus whatever the default experience is of a reference pool of mortgage-backed securities. So when default rates are high, the bondholders are going to get a low rate of return. But if there's no defaults, particularly the riskier of these securities are offering very high rates of return. So just to give you a sense, some of the securities in the first loss position are paying LIBOR plus 9%, so really equity-like kinds of payoffs, but they're absorbing a lot of risk. The ones that are deeper out of the money, even the ones that are very unlikely to ever experience the loss now are paying something like a 90 basis point spread. In fact, as Paul Willen has pointed out, the market voted these the securities of the year, so they've been quite attractive to investors. And in, I think what Dick was planning to say, he told me, is it's notable that that an investor in these securities hasn't lost a penny. So it's been a good deal for investors. Whether it's a good deal for the government, not clear. But so what's interesting is that these things have ramped up enormously in terms of the size over the last few years. So it started out as being pretty insignificant, but now there is a significant amount of securities being issued. I think there's still a debate over how much risk is actually being transferred, and also what would happen to the market in these securities if the market wasn't doing as well as it's doing now. So certainly investors are happy to get these high spreads when there's no defaults in sight, essentially. But if conditions were to tighten, what would that do to pricing? Another issue is that at least so far, I believe Fannie and Freddie haven't used the cost of that credit risk transfer to feed back in their pricing of their guarantee fees. And I mean, in some sense, ultimately, what some people would like to see is that you use the markets to determine a price of credit risk, and then you pass that through to the people who are getting the ultimate insurance. So I just wanted to throw that. So there is a question about how well this market actually will work in the future, but it's the thing they can do with no legislation. And so it is kind of the way that risk is going to be transferred for a while, so it's certainly worth people's attention.
Can I follow up on that actually for a second?
Of course.
So yeah, so I think there are two things that are almost a given going forward. I say almost because I'm not sure givens are, there's such a thing in this political environment. In GSE reform, that is, they're likely to be true whether we see legislative reform anytime soon or not. And my sense is they are that CRT is part of the future system, whether we get to the future administratively or legislatively. That's one. Two, my sense is that you will continue to see a securitization platform built out that will over time become increasingly central to the functionality of the system. I think that if legislation collapses and the administration has to figure out what its path for administrative reform is, you will see just the further development along both of those trajectories. And every proposal out there that has been taken seriously at all legislatively has as its two central features a utility-like securitization platform doing the securitization of the agency securities, and a requirement, or at least a heavy incentive, for those that are doing the guaranteeing or the issuing through the platform to share a large amount of their credit risk, with the point being to disaggregate the functions in the market so you don't wind up with this concentration. Having said all that, there's a wide variation in both the way in which the securitization platform could work, and there's a wide variation in the way the CRTs can work. On the former, you've got kind of there are thin platforms out there that just do the bond administration and that's kind of it. But there are also much, much bigger utilities that do master servicing and a whole host of other things. And where you land along that spectrum depends on how hard you want to work to lower barriers to entry for the guarantors. If you've got a thin securitization platform and you leave Fannie and Freddie in place, it's very hard for other guarantors to come in and compete with Fannie and Freddie because they still hold a lot of the infrastructure the market depends on. If you take a lot of what Fannie and Freddie do today out and put it into this utility, it makes it a lot easier for the other folks that Fratantoni, that Mike was just mentioning, to come in and compete because they don't have to bring quite as much of the highway system with them to do it. On the CRT side, you've seen a lot of back-end capital markets structures to date. Both CAS and Stacker are that way. But as some folks have alluded, that makes the whole structure highly volatile in times of credit risk fluctuation, where nimble capital is, a great execution for the taxpayer in good times, and will get terrible when the markets get bumpy and these investors can go invest in something else. So most people think that you need to mix into that some institution-based capital, some equity kind of capital to cushion against those blows. So there are many different ways in which the CRT can become the centerpiece of the system. So there's a lot of work left to do, whether we go to legislatively or administratively, to figure out what the right mix looks like, frankly, for both.
Okay, good.
Can I build on that just a little bit?
Yeah, go ahead. I also want to make sure we open it up for questions.
So pre-crisis, really the only credit risk transfer that was being done, again, to Ben's paper, was through mortgage insurance on higher LTV loans. Now they've really got three tools in the toolbox. One, they're still sharing risk with the mortgage insurers. Two, they're doing these capital markets transactions. And then three, they're working with some of the reinsurers. The global reinsurers are a big $500 billion pool of capital. They're not investing in these capital market securities, but they're doing something similar through back-end reinsurance deals. And having talked to them last year, a lot of their interest was, boy, premiums are so low in the reinsurance space because we haven't had any hurricanes in so long. So give you a sense that maybe that reinsurance channel may not be open for business. And then on the capital markets, it doesn't, we've had delinquency rates going straight down since 2010. But last spring, you had an issue with China again, currency issue that led to credit spreads in every asset class widening. It got to the point that these deals were uneconomic. So, typically there's a 10 to 15 basis point spread between the guarantee fees that Fannie and Freddie are collecting and sort of the implied guarantee fee. It was negative there for a time. So it didn't even take much of a bump for these things to be non-economic.
Yeah, good. Okay, so let's open it up to comments and questions. Tom?
With the GSEs, we had a duopoly. Thanks. With the GSEs, we had a duopoly, shareholder-owned, which incidentally will erode all of your protections of assuming a good book of business. And with Corker Warner, if I understand it, we have a government guarantee of virtually all of the conventional mortgage market, if I understood right. And my question is, given the distortions in markets from those two options, whether there's any other option out there, at least academically, maybe not politically, that can give us a little more participation of actual market forces.
So let me clarify on the Corker Warner business. So although there is no official proposal out there from any of these guys, I think the general consensus among a lot of those who are interested in reform, and I think those in the Senate Bank Committee who are most interested in advancing this probably fall into this bucket, would be for a system in which you've got much more competition at the guarantor level. So rather than having a duopoly, you'd have, frankly, a lot like the NBA's model. You'd have however many guarantors the market may bear, 4, 5, 6, so that if any one of them goes down, you can let it go down, so you avoid that toxic set of incentives. Yet there is still a fair amount of incentive or requirement that even those push out a fair amount of the credit risk. So again, the objective here being, when you look at the chart, anything that's not in a government bucket can allow for creative destruction without us having to intervene. It's kind of the design goal, as it were. And then as far as market share of all this goes, I don't really think anyone's all that settled on that so much yet. They certainly, I'm sure Corker bristled somewhere not realizing why, wouldn't support, the R's especially, a government backstop of the system that is any broader than what we have today. In fact, there'll probably be, if this goes anywhere, some debate about where well inside of the current footprint the government lands. And my guess is if you don't see reform legislatively, we move to administrative reform, when Melrott's replaced in January of next year, not this coming but the one after that, one of the first things you'll see this administration do is begin to crank back on loan limits and pull in the government footprint. So
I totally agree, given Chairman Hensling at the House, if we're going to get a bill, the footprint's going to be smaller.
Yeah, I think so.
That's the trade-off that you face.
Okay, Scott? Okay, Mike is coming.
One quick question for Mike and Jim each. Mike, on the CRT, you said that there was a period last summer when it became uneconomic. Were you referring to the fact, I mean, it just didn't make sense then to do the deals because they would have lost money on the deals?
Right.
And I think, is it fair to say that that's driven by the fact, you know, that we basically have administered G-fee pricing, and then when you're trying, you know, the market's going to price at the market price. And so that's something I think longer term we all need to be thinking a little bit more about. And for Jim, I was really surprised. I opened up, you know, my email a couple weeks ago, and I noticed, and I'm not going to remember this exactly correctly, but the Republican National Committee, did they actually do like a complete pivot and have said, so my interpretation of it, correct me if I'm wrong, was that they're now behind sort of a recap and release?
Yeah, so I'm glad you asked, well, I'm always sort of glad you asked this.
He loves to speak on behalf of the Republicans.
Yeah, no, especially when there's a confluence of, well, so there's a controversy around whether or not the GSE should be allowed to retain capital. Right now, the arrangement is their quarterly profits are swept to the Treasury as a variable dividend that covers the cost of the Treasury's backstop, basically. And so some have been, Mel Watt, in fact, has been complaining that by refusing to allow the GSEs to build capital, their capital levels have been declining as per their agreement with the Treasury, and it will go to zero in 2018. That is, they will have no capital buffer except for the sort of figurative buffer they've got in the backstop they have through Treasury.
$250 billion.
Yeah, I mean, it's huge. We can get into that if you want. But anyway, there's no technical capital buffer at Fannie and Freddie as of 2018, as per their contract with Treasury. Mel Watt's complained about that. It's largely a political complaint, as far as I can tell, because they've got a $258 billion line of credit to Treasury. The concern is that that when they suffer a quarterly loss and they got to go to Treasury to take, to take down some of that line of credit, Congress is going to go crazy and light Fannie and Freddie on fire, and all hell will break loose and all that. So Mel Watt, understandably, doesn't like that outcome. Has suggested that they should be allowed to retain capital, which would mean that you would change the agreement so they're not getting all their profits to Treasury. So to the RNC's letter of last week, I think it was last week, or 2 weeks ago, whatever it was, they came out and basically in wording that was almost verbatim pulled from the shareholder arguments. The shareholders, not surprisingly, have been arguing that they ought to be allowed to rebuild capital, mainly because they would like to see them recapitalize and ultimately reprivatize so the shareholders can maximize their value. The RNC's change of position on this parroted the wording of the shareholder documents, which gave me at least the view, and this isn't based on having talked to anybody knowing this is what happened, that the shareholder groups got to some staffer at the RNC and they revised this plank without any leadership, at least of people that actually hold offices in the Republican Party. Because when I reached out to Republican staffers and even principals, that is those who were elected to be Republicans, they were horrified by the prospect and were adamant that this didn't show any sort of change in meaningful position among those who actually had the authority to legislate. So they swear up and down that the RNC document was a sort of process mistake more than it was a change in position.
And unless you think this is some grassy knoll conspiracy theory that Jim is providing here, a single hedge fund owns 10% of the shares of Fannie and Freddie, right? So it doesn't take a lot of good news to pump that up a little bit. So there's lots of reasons to put any good news in front of the press.
But I have to jump in on this too, because I think people who aren't into the nuts and bolts of the accounting I want to offer a different perspective. When we say give them capital. Who the them isn't your normal them
Yeah.
for a company. So they're basically owned by the US government. So when the US government sweeps their profits into the Treasury, it owns them, and it provides, as you said, this kind of line of capital. So they do have capital. It's being held in the Treasury. So it's not like the Treasury is squeezing capital out of a private corporation. So then on the side, there are these lawsuits by shareholders who, through everything that happened, were diluted to essentially zero, but the shares haven't been canceled. So there's a political bet that maybe they'll recover something somewhere someday, and they feel like the probability of that is higher if there's some book capital that somehow gets reassigned to the companies. But I just want to make it clear that with this whole recap and release thing might not be what you think.
And the Freddie Mac CEO has been very clear about this on earnings calls, saying, global investors are not looking to the $600 million on Freddie Mac's balance sheet to protect them. They're looking to the Treasury directly. So.
Right. Andy?
One thing I comment you made earlier about the CRT transactions and how much risk they're taking on, and then also to, in the legislation, is it 10% capital or something else? One other thing I think is missing in the U.S. financial system is a method for making those determinations. So in Europe, they also have a thing called CRT, which is almost the same kind of transactions, but CRT there stands for capital relief trades. And the idea is when you shed risk, it reduces your capital. In the US, I guess JP Morgan tried to do a capital relief trade, exactly mirroring what Fannie and Freddie did. And the FDIC or the OCC, I don't know which one of the regulators, basically put the kibosh on that and said, you can do the trade all you want, but this is not going to reduce your capital. And so I guess I'm wondering, one, in the academic community, is there work on that? And then in sort of the congressional side, the policy side, is there some thought process in how we would actually encourage these transactions to occur if we don't have a capital framework that gives you relief for doing them, and then also a capital framework that doesn't give you too much relief for doing fake transactions?
Yeah, well, go ahead.
Well,
You're the CRT guy.
yeah. But part of this is a legislative question of how it's structured. And no one was really that precise on it, but there was always a sense that they wanted a headline number that added up to 10. And maybe they would negotiate down from 10 to something else. But they were counting the total level of subordination, all the all the junior tranches, all the mezzanine tranches as part of that capital. But then they would put a limit on it that would say only half your capital base could be through CRT. Because obviously it's cheaper to come up with 10% subordination than 10% common equity. So the details, I think, were left a little bit, if I remember, to regulatory implementation. But the direction was that you would get capital relief up to some point.
So I'll add to that. So the political history of that moment in the Johnson Crapo back and forth was interesting and very instructive going forward. A member who was very involved in all this, I won't name, was told at some point that 10% capital was going to be the number. So that member who needed to go get other members of this person's party to sign up for a broad government guarantee said, don't worry, with 10% capital, it doesn't matter the government's behind it because we're never going to tap the guarantee. That got a lot of other members of that person's party comfortable. And so then when we all went back to him and said, whoa, no, 10%, that's like an insane number. Did you realize we sort of did the math? He said, well, I mean, my side signed up for 10%. That's what's gotten them comfortable with this government guarantee. And so we ended up spending a lot of the negotiations, to be perfectly honest, watering down what the hell the 10% meant. So instead of going for another number, which we were told was politically impossible, we had to figure out a way to have 10%, but have it comprised of tranches that were less painful than common equity. My sense is this time around, the members of Congress that are most involved in this are much more inclined to defer to the regulator in this. I think if we end up with legislation here, you're going to wind up with a lot more prescriptive mandates for what the objective needs to be for the regulator to solve for, and then more discretion for the regulator to get there. And so capital relief, everybody I've talked to in the discussion has been highly open to the idea of having capital relief play a lot of these functions that, for moving capital in one direction versus another, that, you know, that would make sense as in the CRT process. But my sense is we all run a real risk, as we did last time, of members of Congress picking up on things as proxies for other issues they care about, and we wind up getting stuck with highly inflexible numbers or requirements, or, I mean, underwriting requirements is another. You'll wind up with hardwired into the system some minimum down payment, or, you know, things like that, as opposed to
Maximum default rate was.
the maximum default rate. That was another, that came up at the end of the discussion, where some members of Congress wanted to hardwire in a maximum default rate to determine what the size of the credit box was for loans that would go through this channel. So there'll be this dance in any legislative back and forth where some members just don't like the idea of leaving it up to a regulator to sort through these things, and they're going to want hardwired numbers or requirements. And once you begin to talk about what those numbers and requirements are, they more often than not get demagogued up or down in ways that are irrational economically. So it's a fraught problem.
Do you think banks will get, like, let's say there is capital relief for Fannie, Freddie, or whatever the GSE or
Oh, I see. Yeah.
will banks get the same rules, or will it just be?
We would argue for that.
A non-level playing field?
We would argue for that.
Well, you would hope that, to answer the question more broadly, you would hope that as they move through this process, they're careful about the externalities that they trigger as they decide whatever they decide about this channel. I mean, that's just one example, but I mean, in making big design decisions about this, you're going to determine where capital flows dramatically. And if you don't think about it holistically, no matter how smart you are about this one channel, you're going to screw everything else
The
up.
bigger trying to divide the FHA channel from this channel, even a bigger issue than worrying about the residual bank portfolios, which in effect are just the jumbos right now anyway. And they haven't figured out how to divide FHA from this channel. And that's part of the struggle.
Right. Great. Well, we're out of time, so let's thank the panel for the discussion. I thank you all for coming. I also want to thank Deirdre Wade and Kyle Shofi, who behind the scenes made all of this happen, so thank you very much. Great. Hope to see you next year. Thank you.